Welcome back to Main Street Informant. In this channel, we provide information related to wealth, money, power, finance, business, and economics. In today's video, we will talk about Michael Burry going all in on the worst financial crisis in history. In the 2008 recession, Michael Burry profited hundreds of millions of dollars on the dot-com boom. He now thinks he can make billions of dollars in the upcoming months. Michael Burry's reported holdings are rather obvious if you look up his portfolio online. Burry specifically wants us to see that. Burry owns options contracts for about $3 million and 11 stocks worth $165 million. Burry's public holdings are approximately $168 million. However, Burry's Form ADV registered with the SEC indicates that he oversees $291 million. Where did Burry put the remaining $123 million then? This video will detail how Burry is betting big on the anticipated market crash. Skyon Asset Management, the hedge fund that Michael Burry oversees, is required to report its assets on a quarterly basis in 13F filings, which are the SEC's or Security Exchange Commission forms for reporting institutional stock and option holdings. A 13F filing is required for any institutional fund manager who oversees assets totaling at least $100 million. He must fill out the form by law because he oversees nearly $300 million. Burry holdings 11 stocks and 1 put option, as can be seen on page 3 of his most recent 13F filing. These are bets on his short-term macroeconomic thesis. Burry anticipates that prices will continue to rise and that inflation will continue to pick up speed in a cyclical manner. Burry has selected stocks that will prosper as inflation picks up over the coming years in accordance with his inflation thesis. Input costs are a significant component of inflation. Input costs are costs that arise during the creation of a product or service. This is due to the fact that higher pricing will result in higher input costs and, as a result, reduced profit margins. For instance, the two main input costs facing the airline industry right now are rising fuel prices and wages. Because fewer people will buy tickets at a higher cost, airline businesses will make less money. In moments of inflation, Michael Burry is fully aware of the significance of input costs. He owns 11 stocks with a common theme, totaling $165 million. These investments can be divided into the following 4 categories: travel, technology, healthcare, and value. The 2 travel businesses that Burry owns tend to gain a lot from rising oil costs. For instance, Booking Holdings, an online travel agency, receives a predetermined commission from reservations. The profit of Booking Holdings will increase as ticket prices rise. And the second holding, Ovintiv, is a shareholder in a natural gas extraction business called Encana. This implies that Affinity's profits will increase along with petrol costs. Owning businesses with the capacity to raise prices gives Michael Burry the ability to demonstrate great pricing power. Because they are built on the internet, which has negligible material cost, he also purchases tech stocks with low to no input expenses. The valuations of his value stocks have less opportunity to decline because they are trading at a significant discount to their true value. Even though his assets are separated into 4 categories, the majority of the businesses had traits in common. Nearly every single one of them has incredibly high profit margins, significant competitive advantages, tremendous pricing power, enormous cash holdings, and low valuations. Out of all of them, price power is the most crucial one. Pricing power, particularly during inflationary times, was previously deemed the most crucial component of any corporation by Warren Buffett. As inflation picks up speed, having pricing power guarantees that businesses will continue to turn a profit. Burry has placed options on the Apple shares as well. Contracts to sell 100 shares of stock at a specific price are known as put options. Consider a put option in Apple stock which has a $150 strike price and an expiration date of September 15, 2023. By September 15, 2023, the owner of this put option has the right to sell 100 shares of Apple at $1,500. Burrys options contracts to sell 206,000 Apple shares. However, neither their cost nor their expiration dates are known. We can confidently estimate the contract price at about $15 per contract based on the current option prices. Burrys Apple put options are only worth about $3 million according to this. Burry is purchasing puts on Apple due to the company's high input costs for its hardware products. iPhones are made up of a complicated assortment of parts that are put together to form the finished product. The cost of making the iPhone includes all of these components. Burry has revealed holdings totaling an estimated $168 million in positions. But where is Burry's management of the remaining $123 million? Let's break it down. Stay with me. Okay, you see, Burry has 6 options for where to put his remaining money. He might be investing in bonds, hoarding cash, trading foreign exchange, buying commodities and farmland, shorting stocks and cryptocurrencies, or betting against bonds. These options are included since they do not need to be disclosed to the public through SEC filings, which is why I listed them. The only locations Burry could invest money in are the ones I've already mentioned. Burry predicts that cash will depreciate at an alarming rate, so we can rule it out. What about the Forex market then? In the Forex market, often known as a worldwide marketplace, people trade fiat currencies, which are backed by governments. Trading Forex involves placing bets on which fiat currencies will perform better than others. For instance, by trading the USD for the euro, investors may wager on the euro currency outperforming the dollar. In the event that the value of the euro increases, this would enable the investors to convert it back into dollars. The dollar has been performing well on the foreign exchange market despite its rapid appreciation. This is because other countries are printing even more money than the United States. The problem with Forex trading is that you have to wager on one currency performing better than another. And as Burry himself noted, the dollar cannot be shorted because it is relatively strong in comparison to other currencies. What is the next option for Burry? Well, he could buy farmland, gold, or silver. Agricultural land and commodities have historically been effective inflation hedges, but only in cases of moderate inflation. In current hyperinflation, the best assets might be slightly different, according to Burry. Even farmland wasn't secure from confiscation or punitive taxes, he said. This chart historically illustrates favorable locations to be amid big but rather moderate inflation. Governments often attempt to keep their currency strong during hyperinflation in order to prevent unrest. In order to preserve the value of its currency because a decline in its value puts the government in a fragile position, governments frequently tax or seize assets that are performing well. Burry predicts that the dollar would see double-digit inflation rates, which would place the US dollar in a weak situation. In another tweet, Burry elaborates on this idea, writing that, in an inflationary crisis, governments will move to squash competitors in the currency arena, Bitcoin and gold. Based on these tweets, we may assume that Burry doesn't own any commodities or farmland. Burry doesn't see the point in taking on the additional risk of taxation or confiscation. Burry's next choice is to short stocks. Burry is probably shorting speculative stocks because he believes that stock prices will crash. It would be reasonable to presume that Michael Burry is shorting equities because it is obvious that he believes that stocks will drop sharply in the near future. Before selling them in October 2021, he previously owned Tesla put options. The cues indicate that he most likely switched from put options to straight shorting. This is a result of the option premiums being too expensive. Put option holders would only be up 100% even if stocks like GameStop went to $0 in 2 years due to the extremely high option premiums. That is absurd since shorting is a much superior course of action in that circumstance. While having no expiration date, shorting a stock gives you the same 100% upside potential. Borrowing shares of a stock and selling them on the open market is known as shorting. The objective for short sellers will then be to repurchase those shares for a cheaper price. Let's imagine, for illustration purposes, that I sold 1,000 shares of a stock for 5,000 euros and then purchased them again for 4,000 euros. I now make €1 for every share, or 1,000 euros in profit, because I purchased the shares at a €1 discount. Short sellers do the opposite by selling stocks and attempting to buy them back at a lower price, as opposed to buying stocks at a low price and selling them at a high price. If the stock drops to zero, I can profit to a maximum of 100%, which is the exact same as the upside for put options on GameStop. Burry most likely changed from purchasing put options to shorting Tesla shares as a result. Burry is probably a short seller of equities based on his outburst against others who criticize short selling. Although we cannot be certain, there is strong likelihood that Burry went from purchasing put options to shorting stocks. Burry shorting cryptocurrency is another potential scenario. Considering how speculative cryptocurrencies are, Michael Burry is pessimistic about them. Burry has previously considered shorting cryptocurrency, but as indicated by his email to CNBC in 2021, he has decided against it. Burry can short bonds as his final resort. Fortunately for us, Burry admitted to shorting bonds. Burry's largest bet is probably to short via 30-year treasury bonds. What makes Burry short 30-year bonds then? Bondholders who retain their bonds for the entire 30 years will earn a 3% yearly return because the yield on a 30-year treasury bonds is now about 3%. Bond prices and yields are inversely correlated. Therefore, rising bond yield would result in falling bond prices. In general, long-term bonds are more impacted by an increase in interest rates. Price drops for 10-year bonds will be substantially greater than for 6-month bonds. Bond yield and price have an exponential relationship that gets stronger as interest rates climb. Burry is shorting the most volatile bond by shorting 30-year treasury bond yields. Michael Burry has a reputation for taking extraordinary risks. In 2008, he essentially invented brand new security called credit default swaps. In the first quarter of 2008, he was able to make 166% return for his investors because of this new security. Burry bought put options on the iShare 20+ year Treasury Bond ETF in August 2021 and sold them later that year. Burry most likely turned to credit default swaps in his outright shorting because option premiums are pricey. Credit default swaps function similarly to bond insurance. You must pay a monthly premium to insure your home if you purchase earthquake insurance. As long as there are no earthquakes, the insurance will be profitable each month. The value of your earthquake insurance will suddenly be thousands of times greater than the sum you paid though, if there is an earthquake. Credit default swaps are similar to purchasing bond insurance. Investors are required to continue paying the monthly insurance fee as long as the bond does not default. Credit default swaps are particularly important during a breakdown in the bond market, just like earthquake insurance is following an earthquake. During the 2008 recession, Burry made hundreds of millions of dollars by purchasing credit default swaps. Now that the government cannot bail out corporations as it could in 2008, he thinks he can earn significantly more. Burry was fortunate the first time around since he was compelled to sell his credit default swaps prior to the government, saving a huge number of businesses. Nevertheless, he is aware that the financial infrastructure will not be expanded again given the prevailing political storylines. This brings up the potential for burying corporate bond credit default swap purchases. Bonds issued by corporations are known as corporate bonds. Compared to US government bonds, corporate bonds are more likely to default, hence they often have higher interest rates. Burry bought credit default swaps on mortgage-backed assets during the 2008 recession because he thought that the housing bubble would burst. Now that he thinks the established banking system will collapse, it would not be surprising to see him use credit default swaps to short banks. He invested $17 million in GameStop and turned it to $270 million. Because of how bizarre and profitable his bets are, the SEC always put him on the radar for any potential wrongdoings. Burry recently made his most audacious prediction when the rest of the world is still asleep. After the stunning invasion of a new nation, he now thinks that World War III is likely to break out. Burry claims that a completely new phase of compression is coming and that the suffering is just halfway to the end. I sincerely hope that you found this news to be helpful. Please like, subscribe, and hit the notification bell for more specifics on Michael Burry and his fearless predictions on global crisis or business and economy. You can check out more videos on the channel and share. It will help my videos to reach more people. See you in the next one.